Now, there is one more formation on the stock market charts that I think is worth mentioning, because every so often the market gets dramatic and shoots up or takes a terribly big plunge, and sometimes it leaves a gap between days of trading. Look at this. There's a hole right here. This is called a breakaway gap. Sounds like a cowboy movie, breakaway gap. But actually, it's a very important sign. It's telling you something about your stock that you should not ignore. Breakaway gaps usually happen on days with high trading volume. Now on the day that this gap occurred, look at this. See, this is the amount of volume on that day. These days are real kicks. They tend to push the stock in some strong direction. Watch what happened after this gap. The next day, the day after, the day after, the day after, prices drop dramatically. They start a momentum that can continue over time. If the push is up, like here's a gap going up, look what happens. Days, weeks, months, the stock keeps rising. If you get a breakaway gap when the stock is near its level of resistance or support, that could mean that the stock is about to break through the floor or break through the ceiling, and you may have to adjust your decisions accordingly. Basically, what all this means is that the price pattern of your stock over time could change after one of these breakaway gaps. And if you haven't changed your opinion about the stock, at least after one of these gaps, take a second look, because it may be time to make a move. All right, next up, we are going to talk about how to detect major market shifts.
What kind of a chart is this? It's a breakaway gap, a break in the stock price pattern that's caused by either a big push up or a big push down. If a stock is up near its ceiling or level of resistance, it's a good time to buy. True or false? False. Traditionally, the ceiling is the stock's highest price. You should think about buying when the price goes down and the stock hits its floor or level of support. Which three numbers from a stock's price listing do you use to make up a stock chart? A, yield, PE, closing price. B, dividend, PE, 52-week high price. C, high, low, closing prices. D, sales, yield, net change. The answer is C, the high, low, and closing prices. They're the ones you need to make a stock chart.
The stock market is a volatile place to be. It is always changing. But the most crucial moments are when the market hits a major turning point, whether it is swinging from bull down to bear or from bear up to bull. If a bull market is ending and stocks are about to plunge, you can lose a lot of money if you're not aware of it. Or if a bear market is ending and stocks are ready to come out of hibernation and zoom up, you can miss a great opportunity if you're not prepared. So one of your major jobs as an investor is to try to figure out when the market is going to make one of these shifts. It's never easy. And there are no foolproof ways to do it, but we do happen to have some guidelines. First, the good news, bear to bull. There are 4 signals that tell you that a bull market is about to take off. Not all of them will be apparent all the time, but many will. Number 1, before things look up, the market has to have declined a lot and for a long time. Declines during a bear market can last anywhere from 6 months to 4 years, but you almost never get a bull market without a significant decline first. Number 2, the rate of decline should begin to slow. The market should be dull, volume low, day after day, sometimes for months. There's no stock market talk at the parties you go to, nothing about it in the newspapers. Nobody is buying stock, not even top quality stocks, which are selling cheap. Number 3, price-earnings ratios are very low.
investors aren't even interested in companies that are making money. And number 4, even when there's bad news, the market doesn't drop. It shows that stocks just refuse to fall any lower.
Add it all up, these are signs that the market may be about to turn because things are as bad as they're going to get. The only way to go is up. Bull markets usually start very slowly. Now, at first, there's nothing obvious. Volume starts to expand, but slowly. In the inevitable ups and downs from day to day, volume's higher on good days, but then it goes lower on bad days, up again and down again. And as the market improves, breadth increases, and then advances, beat declines on a regular basis, and now we're at the turning point. It's not very dramatic. You probably hardly noticed it, but it's easy to miss. It's time to make money in the market right now. If you buy now, at the turn, you'll be buying very low, and when the bull starts to rage, you'll be able to sell high.
Now the bad news, bull to bear.
Bear markets usually start with a crash. This is the dramatic side of the market. Bear markets start violently. Look at this turn here. With disastrous price drops, extraordinarily heavy volume. This is where people lose money big. So you must learn to recognize that turning point, and we've got 5 clues for you.
Number 1, before it falls, the market has had a long and substantial rise. Nobody wants to see the good times end. Investor confidence and enthusiasm are soaring. Everybody's asking each other for stock tips at parties. It's all over the newspapers. This is going up, that's going up. Nobody believes anything can go wrong. Right there, get worried. Number 2, new stock issues will be hitting the market at a record rate, but fewer and fewer people will be willing to buy them. So prices for new issues start to fall off. That's another danger signal. Number 3, when there is good economic news, the market doesn't respond. This is a bad sign. Even the economy does not push people to buy anymore. Number 4, market volume fades. Volume is down on good days. There's little buyer enthusiasm. On bad days, the volume goes up. People are now pulling out of the market. That is a strong signal that the bull market could be ending. And number 5, stock group divergence. The market as a whole is still heading up, but some important groups start to drop off. Now, this means that the market is getting more selective, and the decline in that one group might take other groups with it.
Taken together, if all 5 of these signs are present, well, that should add up to a pretty large flashing red light. And you've got some decisions to make. The crash hasn't come yet, but it's coming. Don't get fooled if everybody you know is still very confident. And don't feel bad if you sell your stocks and the market keeps going up for a month or so. So you got out a little early. At least you avoided a very big mistake. It's the guys who hang on who are going to lose the most in the end. So don't be greedy. And I'm going to tell you a little market saying. Bulls win, bears even win, but hogs get slaughtered.
Which is easier to miss, the beginning of a bear market or the beginning of a bull market? A bull market is easier to miss because it starts slowly and undramatically. If new issues are hitting the market at a record rate, but buyer enthusiasm is dying out, it could mean the beginning of A, a bull market, B, a trader's market, C, a bear market. The answer is C, a bear market. If volume is up on days when prices drop and down on days when prices rise, it probably means A, the bear is coming, B, there isn't much market activity, C, the bull is coming. The answer is A, the bear market is coming. When people are trading heavily and there is selling pressure, the market will decline.